So I'm going to be brief here. So when I took on as chair of the IVC LP Council, as a LP group, we deliberated on how we can look to support the India private capital opportunity outside of our institutions. And we realized while each of the LPs have their own views and a place for India in the context of their own portfolios, there wasn't an aggregate data-driven perspective of the global LP perspective on India, including barometers around LP engagement on things like fund investment, secondaries, and direct co-investment opportunities in the market. I was really glad to see our friends at McKinsey really step up to this challenge. This certainly has been a collective effort from the IVC's LP Council, the IVCA itself, as well as a lot of GP friends in the audience here as well, but really a humongous effort on the part of Vivek Pandit, Piyush Dalmia, Dave Roy, and Mol Chaudhary at McKinsey. So on behalf of IVCA and the LP Council, I'd like to extend a sincere thank you to the McKinsey team. Fair to say that most LPs are not very enthused when you ask them to take 20 to 30 minutes to complete a very detailed questionnaire. So I'm glad to report that in the end, we still managed to get some quality responses from a lot of global LPs and some select domestic LP institutions as well. To walk you through these findings, I now invite my friend and senior partner at McKinsey, Vivek Pandit, to walk you through the report.
Okay, wonderful. Just watching time. I'm going to do a 45-minute presentation in 10. And that is a special IVCA only moment. Okay. Without further ado, let me just say this. Thank you, Kunal. Thank you to IVCA. Thank you, Akriti. Thank you, Rajat Tandon. Thank you, everyone. You know how difficult we can be when our name is on a report. And so we followed a lot of very strict guidelines in putting this data together. The reason is Chatham House rules is immediately following this as a media event, and we don't want to be misquoted here. So if I can be a little more candid with you here, I will be, and the media event will have a separate session. First, the good news is we had a very wide-ranging group of LPs who responded to what was a very comprehensive survey. It was very well represented. As you can see here, we had 53 responses. The domicile of LPs is North America, APAC, India, Europe, and the Middle East. And allocation channels for those LPs, most of them allocate to multiple channels, some only to global funds, some to India dedicated funds, some to Asian funds. But what I can tell you is that 51 of the 53 that responded had direct exposure to India. Only 2 of the 53 were planning to invest in India, and that therefore their responses, of course, are in here. But most importantly, this is an informed group of LPs, and so their voice matters, right? Their voice is reflective of their experience. I'm going to quickly go through this as background. I think we all know where we are. If you look at the last 2 decades, in the first part of those 2 decades, we deployed about 105 billion. In the last decade, we've deployed almost 440 billion. We've gone from 0.68% of GDP to 1.42% of GDP. Just, by the way, this sort of matters. As LPs talk to us, they also referred a little bit to how much more absorptive capacity there is in the market. There's a general sense that there's much more absorptive capacity, but as you'll see in my presentation, India suffers from four to five elements of concentration, and we'll talk about what that concentration represents. The good news, well, good, and in a contracting Asian environment, India is still holding up, right? So put it this way, even though Asia is contracting, India is contracting a little less so. As a result, India has gone from 12% of Asian deployment to 21%. This is good. This is good in the sense that if you're going to be in India, if you're going to be in Asia, being in India is almost a must-do, not an absolute, but almost a must-do. And by the way, this is in large part driven by the contraction that we've seen in Western LPs' interest in China, right? Now the question is, can India hold on to this position even as allocations rise across Asia? Concentration, again, I won't go through this. This just shows you that Growth and buyouts tend to dominate. Growth buyout plus VC tends to dominate in India, and I think we all know why. But we'll come to this in a moment, which is effectively 60 to 70% is growth buyout VC. Real assets, infrastructure, real estate, and we'll talk about secondaries as well, are much smaller than you would anticipate, given the amount of investment going into it. And we'll talk about why LPs feel a little hesitant about their position on infrastructure, real estate, and up till now, secondaries. I think we all know this, but this is another form of concentration. In India, the top 5 sectors represent almost 75% of all deployment. This isn't necessarily a good thing. This is one of the things that rate limits a 4 trillion economy from moving beyond the deployment numbers we've seen. And we'll talk a bit about what LPs intend to do relative to where they've seen capital deployed. Another form of concentration, LPs do comment, and I won't name the funds, many of them know who they are. 64% of the Indian market is concentrated in 6 funds, domestic. This is domestic, does not take the global allocation. This is another form of concentration, and by the way, those funds are largely private equity. They're starting credit, there are a few other pieces to it, and the reason is selection criteria for funds matters. And I'm going to go through what LP said about selection criteria for India, private equity, and for fund managers themselves. But this concentration, for better or for worse, we actually see this concentration persisting. Despite the fact that we do want to see many more asset classes open up, this concentration is likely to persist. There are many other markets where this concentration has persisted, and those markets tend to be Western invested, complicated regulatory environments where people are much more comfortable investing with the familiar than taking a bet on the slightly unfamiliar in a very unfamiliar environment, right? And so to the extent that domestic capital is not coming in force, domestic capital comes into force, we see this shifting. Domestic capital does not enter, we see concentration remaining. And I don't have to explain why, we don't have time right now, but there's a lot behind it. Deployment, we've done better over the last 5 years. We've seen 120 billion exit versus the previous era of 59 billion. This is good. Good, not good enough, but good, just context. This is interesting. Now, if you look at the people we surveyed, this is simply an outcome. This is not planned, this is an outcome. People we surveyed, 36% of their exposure relative to Asia was in India. So a third of their exposure was India. Now this is kind of important. As you can see, obviously for the Indian LPs, it was largely India. Europe, interesting, almost 60% of their Asian exposure is India. Middle East, about 35%, APAC, 25%, and North America, 21%. And a lot of this simply reflects the allocation channels these LPs prefer. Global funds, regional funds, India dedicated funds. And so again, today I don't have the time to get into the detail, but as you walk through each of those LPs' preferences, it becomes quite clear based on their portfolio construction, beta requirements, risk requirements, and liquidity needs, why this is the way it is, right? They become quite sophisticated understanding where you can get long duration matching and returns, but have to trade off liquidity for that, right? And so this reflects some of that preference for liquidity. Okay, this is where some of the synthesis of the report comes in now. India, here's the good news. Among Asia, and we did not know this would come out, India absolutely tops Asia today as the leading investment destination, and this is largely global LPs. Okay, largely regional and global LPs. Japan, number 2. Southeast Asia, then Australia, South Korea, and China. Now remember, these are LPs who have a choice of allocating wherever they might. Obviously, Indian LPs are a little more restricted in their allocation. What's interesting, though, is that if you look at LPs below 25 billion, India ranked as number 1. If you looked at LPs above 25 billion, Japan ranks as number 1. Right? And again, that's not surprising. India, smaller ticket, not always control, high multiple, high growth, low leverage. Japan's exactly the opposite for these LPs. Large ticket, lower growth, low multiple, high leverage. So you couldn't have two more opposing poles when it comes to the investment attractiveness of two destinations, the kind of risk you're underwriting, right? But this is sort of where LPs land, and it's quite different. Before I go there, we asked LPs a lot of questions that I think people hadn't asked them a little openly earlier about what they love about India, macro, what they like about India as a structure for private equity, and how they think about Indian managers. And what we found interestingly was there was a clear bifurcation. There were LPs who were sophisticated, leaning forward in India, and LPs who have had exposure to India but were a little less eager. So what we did is we divided the group, after we looked at the numbers, into two groups. One group that had a significant allocation plan for India, and the other group that had invested, but whose plans for India were a little more muted. And we wanted to see how those two groups viewed India and the opportunity set. And so here's what we found. First, on India macro. What I'd ask you to look at is, you see the light blue, orange, and red? Light blue is where, whether you're a high allocator and planning to allocate high, or you were a allocator and you were relatively moderate, green is that light green is where everyone agrees. India is strong, political stability, economic stability, geopolitical risk, and tariff. We got into a little bit of it. We won't get into the tariff point right now, but there's a lot behind that insulates India, or at least the investment approaches to India are somewhat insulated. The places where there was consistency on India being relatively worse than other markets they invest in. The question actually was, relative to other markets you invest in, where does India stand, given you have the opportunity to invest in multiple markets? And the places where there was consistency again on where India did not rank well was compliance, contract enforceability, valuations, which of course no one's ever happy with, tax regime, ease of doing business, and currency risk. No surprise here. No great surprise, but what was interesting is that there was consistency, whether you're a high allocator or a moderate allocator, there was consistency that people felt strongly about both these two categories. Finally, if you look at the orange, where there are diverging views, this is interesting. There are diverging views between these LPs on how important inflation is, rule of law, legal support, regulatory consistency, governance, and foreign investment policy. Now I'm going to, you just hang on to that for a minute, because I'm going to go through some information that will make clear why there's divergence in these views. There's a reason for divergence, and we'll get into that now. If you look at drivers of growth, right, just from a structural perspective of what makes private equity attractive, what makes a market attractive to private equity, that you can see here, for the high allocators, they're entirely focused on entrepreneurial talent, GDP and economic growth, exit potential, availability of targets. There's a fairly robust set of scores here that are above 5, right, which is relatively better than other markets. When you go to the moderate folks, they'll say, look, India scores highly on entrepreneurial talent, GDP growth, domestic consumption, and we even talk about Make in India. Everything else is so-so. So the way they view the India macro environment is different. So knowing how LPs view these factors for India actually does matter. Now, I'm not talking about from a fundraising perspective, but there are global LPs who simply aren't, we'll come to what the big takeaway is. LPs who allocate and gotten more comfortable are allocating in a much more concentrated way. People who are not comfortable yet have not figured out how to seek out the concentration where the returns justify the risk. This is an important point, because it's not always clear to people as to why there are two very different views on India. Here's another one. When you're selecting private market managers in India, what are the criteria that you use? What do you care most about? High allocators care about, I want to see there's a huge pipeline of opportunity. I want to see risk-adjusted returns, manager quality. And by the way, exit record certainly matters. Interestingly, everyone talked about exit record. But the high allocators have figured out, I know the people who can deliver the exit record. I want to know I can deliver a larger check with more deployment opportunity against a reasonable return. I'm not overly focused on DPI, but don't get me wrong. Everyone who talks about DPI is not wrong. The problem, though, is that most conversations around DPI are centered in aggregate. It's an easy thing for an LP to come back to you on and say, hey, look, DPI matters. I'm focusing very strongly on whether you even meet the gate on DPI. Moderate allocators, number one, DPI. That's what you keep hearing at every panel. Governance and disclosures, risk-adjusted IRR. And then they get into management fees and costs and deployment. In other words, moderate allocators had more factors that they weight than some of the high allocators. And I'm going to argue for a minute here, this is purely a function of familiarity, and a function of their own experience with managers. Now, looking forward. So first off, we asked about public alternatives and private alternatives. Turns out most of the people surveyed were more heavily weighted towards private markets, right? So private alternatives would be hedge funds and other arbitrage funds and other funds that take advantage of public market dislocations. Fund of funds, very clearly, largely private. Insurers, about 2/3 private. DFIs, about 2/3 private. Family offices, similar. Endowments and foundations, about 40%. Pension funds, 14%. It's kind of important. Pension funds after COVID and after the GFC and after COVID, pension funds around the world started portfolio construction around elements of liquidity and beta much more sharply. Because after GFC and after COVID, they realized they were exposed. And so instead of worrying about geography, sector, and long-term themes, there was a pendulum shift towards liquidity, beta, and beta-adjusted returns, and the capacity to actually exit when required, right? And that's what you see here. And this is also important. Understanding the nature of the LP plays a significant role in understanding their preference and understanding what they're willing to bet on, private versus public. And by the way, I know that we have in store, hopefully we'll see more domestic pensions open up. The fact is, pensions are generally biased towards public. We asked them then, looking ahead, what are you most excited about? Well, unsurprisingly, private equity. Interestingly, second was secondaries, climate, infrastructure, then private credit, and last real estate. Now, this should not be a huge surprise. The conversation we had with LPs about why secondaries. They're like, look at all the unexited opportunity. We hear three things. We hear we're not able to exit, yet we hear we love the assets we haven't exited yet, and yet we hear there's no vehicle from which. So there were too many conversations they were having with fund managers about setting up continuation vehicles. And there was a real question mark about, do I really want the same fund manager rotating the capital back into another continuation vehicle? So they were quite candid about this. And I think the hope is that there will be true independent secondary funds that emerge where you can truly understand the quality of these assets. They're not totally convinced that the quality of the assets are what they're represented on the books. And so the marks, this represents sort of a concern, both a concern and an opportunity. Concern that the marks are high and not as attractive, and it'll trade out from manager to same manager at a rate that supports the fund, but may not support the next secondary. And of course, they believe that therefore there's an opportunity for more secondary in the market, right? For someone who's able to pick out and get those assets at a reasonable price. On strategy, continues to be buyout, growth equity, venture, seed. There's generally, I'll just say this, among the LPs we surveyed, there's generally more appetite for later stage, and that's not surprising. I think the biggest comment we heard was The power law for venture doesn't play out in India the way it plays out in other markets where these LPs have options. And so their broad concern was too much capital and MOICs that didn't quite justify the risk profile of India, especially given, despite, it was interesting, they did not see the Indian public markets as being a huge, huge positive. They said that's fine, but it's not, it saved a few people and everyone was concentrated in a few deals and those guys got lucky. But I think there was a general sense that if I'm looking at an MOIC of 2.5 to 3, that doesn't really justify the risk of venture. I'm looking for a much larger return on venture in dollar terms. So this is not to say that there isn't healthy interest in venture. It's just to say among the options they have, they'd rather do later stage in India for this group. This surprised us. We thought we would see, it first surprised us, then it didn't. We thought we would see a difference in how, by strategy, LPs rated sectors. I'm going to give you the quick answer because we don't have time. The quick answer is the sectors LPs care about most are the same sectors that offer mitigation of currency risk, inflation risk, liquidity risk. And by and large, again, we won't get into all the details, lots of commentary on why, even by strategy, the sector selection was so similar. We would not have expected this, right? But then when you look at how sophisticated LPs have picked managers, they have picked them on the basis of a strategy that is consistent with their need to avoid India-specific risk. Again, I won't get into detail. There's a lot more behind this, sector by sector, what they like, what they don't like, and their experience with returns. Other piece of good news, well, India is actually a pretty heavily co-invested market. Okay, pretty heavily co-invested. And this is not bad, this is good. We heard two comments. Comment one is, Indian domestic managers are willing to give up co-investment to maintain pricing. Like, that's fine. If you want to maintain pricing, that's fine, but we're going to be co-investing. Second is the co-investment, by the way, is another form of concentration. All the co-investment checks that get written end up in these sectors as well. They tend to have higher absorptive capacity. The good news about co-investment, and this was not true a decade ago. I remember we did an independent survey that we never published about a decade ago on co-investment performance, and it was not so great. Today, much better. So over half said their co-investments outperformed the fund. 40% said they were at par with the fund, which was actually fine, and only 4% said underperformed. This, by the way, is really important if you have an active co-investment desk that's looking for more exposure without the fees. We asked them about fund sizes. Let's just put it this way. Somewhere between 250 to $1 billion is where LPs believe there's enough absorptive capacity for a single manager. Don't get me wrong, there'll be $3 billion funds and there'll be $100 million funds. But in generally, the Goldilocks zone is 250 to $1 billion. Too small to be relevant and access better opportunities on the downside. On the upside, on the high side of the range, the question mark is really, is there enough opportunity for them to deploy? Right? By the way, this is, just to be clear, this is simply how they rated these size funds. On the right side, what was interesting is, although the 43% stands out, over 50% said they would allocate to more than 5 funds if the opportunity presented itself. So in other words, I think they are, as we saw, they're looking for expansion in asset classes, they're looking for expansion in number of funds that they want to invest behind, and generally those two are good. And so therefore we believe the amount of capital available to the country will only increase in this pool of investors. However, as we talked about before, the high allocators versus the moderate allocators think about India quite differently. If you were really conservative, the moderate allocators are basically betting on the record. The high allocators are betting on the potential because they've seen the record and a positive record. The number of LPs we spoke to who had perhaps not so positive things to say about India were not insignificant, right? And by the way, it's interesting, they have an elephant's memory on deals and funds. And it just keeps replaying back. You might argue it's a bit unfair, but we kept hearing back over and over about some of the missteps. But this is where we are today. This is the final chart. I'm going to not present after this. This is interesting. There's a lot of detail behind this, but let me just explain it. These are the top selection criteria in aggregate to choose a fund manager in India. It's on the left side. Performance record 1, DPI 2, quality and tenure of investment team 3, value creation group 4, and everything else was sort of a distant second. But if you look at where India ranks, it's kind of moderate. I think partnership opportunities, giving us pricing, so giving us co-investment opportunities, India does really well. Everyone says the Indian manager is willing to give up a lot of co-investment rights. And everything else is a bit moderate, but here's what's more telling. On the right side, look at performance record. The bottom 20%, 4. The top 20%, 7. And so there's a lot of variation in these. And I think the big takeaway for us was, on the factors that matter most, the variation is high. I'll repeat that. On the factors that matter most to LPs on GP selection, the variation in experience is high. On the factors that didn't matter as much, the variance, at least the way they saw it, was lower. In other words, the 64% I showed you earlier, which represented sort of a winner-take-all environment, that is likely to persist if this perception persists, right? Which is, there are some really good players and some not good players, or my exposure to India has been either really good on this dimension or not good in this dimension. It's interesting, of course, the only other place where you see a significant deviation is sectoral knowledge. Significant deviation. Just the knowledge of fund managers understanding the sectors they're investing in. They have a point of view on this. And so let me stop here. If you want, there is I'm not going to skip this. If you want a copy of this report, you can get it by just contacting one of us. And IVC, of course, has access to all of this. Thank you.
A report that provides valuable insights into how institutional investors are thinking about India's private market. Ladies and gentlemen, the India LP report by McKinsey and Company, here getting officially launched. Let's share it up. Let's have a big round of applause.